There is a number sitting on the balance sheet of the United States government that has not changed in over 50 years, and that number is quietly becoming one of the most important figures in the entire global financial system. It is the official price the U.S. Treasury uses to value its gold reserves, 42.22. Gold is trading in the market at roughly 100 times that figure, and for the first time in half a century, serious people inside government, inside the Federal Reserve, and inside the bond market are asking the same quiet question. What happens if Washington simply marks that number up to reflect reality? Not confiscation, not conspiracy, just an accounting entry. But an accounting entry big enough, some argue, to rewrite the relationship between the dollar, the debt, and the metal sitting in vaults from New York to Kentucky. I want to walk you through exactly why this conversation has moved from the fringes of the gold community into research papers published by the Federal Reserve itself, and why the evidence, not speculation, suggests something is shifting beneath the surface of the financial system. Stay with me, because by the end of this, you will understand not just what is happening, but why it is happening now, and why the answer connects almost everything else going on in markets this year. Before we go further, I want to know something. Comment below and tell me where in the world you're watching this from, and whether right now your own savings are sitting in gold and silver or simply in cash. I read these and I'm always struck by how differently this question lands depending on where someone lives. Someone in Argentina or Turkey answers that question with a completely different set of instincts than someone in Switzerland or Singapore. And that difference itself tells you something important about how currencies actually behave under stress. Keep that thought in the back of your mind, because we're going to return to it. Let's start with the plainest fact, the one that explains almost everything else. The United States government currently owes a little under $39 trillion. That is not a hypothetical number or a projection. It is the balance as of the middle of this year, and it has been climbing at a pace that would have been considered alarming even a decade ago. The Congressional Budget Office projects the federal deficit will run close to $1.9 trillion this fiscal year alone. And by the mid-2030s, absent a change in policy, that annual shortfall is expected to grow toward $3 trillion, driven overwhelmingly by one thing: interest. In 2025, the United States paid out roughly $970 billion simply to service its existing debt. In April of this year, a single month's interest payment hit a record above $110 billion. Let that sit with you for a moment. The government is now spending more to pay interest on money it already borrowed than it spends on national defense. That is not a talking point. That is arithmetic. And arithmetic, unlike politics, does not care which party is in charge. Here is why that matters for gold and silver, and why it matters more than any headline about tariffs or elections. A government facing that kind of interest burden has essentially four levers it can pull. It can raise taxes, which is politically brutal and slow. It can cut spending, which is equally brutal and slow. It can grow its way out through faster economic expansion, which would be wonderful, but cannot be conjured on command. Or it can inflate the debt away quietly by allowing the currency in which that debt is denominated to lose value over time, so that the dollars being paid back are worth less than the dollars that were borrowed. Throughout history, when the first three options prove too painful or too slow, governments gravitate toward the fourth because it is the only lever that does not require asking permission from voters or from a divided legislature. This is not a new insight. It is the central argument of Ray Dalio's work on the long-term debt cycle, and it echoes what economic historians have observed in nearly every major sovereign debt crisis of the last century. From Weimar Germany to Latin America in the 1980s to Japan's decades-long struggle with its own debt load. When debt service becomes unsustainable relative to growth, currency debasement becomes the path of least political resistance. Now, here is where gold enters the picture and where the story stops being abstract. Gold has functioned as the ultimate form of money for roughly 5,000 years, not because of superstition, but because of a simple physical property. It cannot be created by a printing press or a keystroke. Every other form of money in circulation today, dollars, euros, yen, is a liability of a government or a central bank, a promise rather than a thing. Gold is nobody's liability. It sits outside the system, which is exactly why central banks have historically returned to it during moments when trust in paper, promises, begins to erode. And that is precisely what has been happening. Central banks around the world, not hedge funds, not retail traders, but the institutions that manage national reserves, have been accumulating gold at a pace not seen in generations. This is publicly documented in World Gold Council reserve data, and it reflects a deliberate multi-year strategy among countries seeking to reduce their dependence on the dollar as the sole reserve asset. When the institutions with the longest time horizons and the deepest information advantage are quietly building positions in something that is usually worth paying attention to, regardless of what the price is doing on any given Tuesday, Silver tells a related but distinct story, and it's worth separating the two, because conflating them is one of the most common mistakes new investors make. Gold is almost purely a monetary asset at this point. It has some industrial use, but it is overwhelmingly held for its role as a store of value. Silver is different. It is both a monetary metal with the same multi-thousand-year history as gold, and an industrial commodity essential to solar panels, electric vehicles, electronics, and increasingly artificial intelligence infrastructure and data centers. That dual identity is why silver tends to be more volatile than gold in both directions. According to the Silver Institute, the market has now run a supply deficit for 6 consecutive years, with mine production structurally constrained because most silver is produced as a byproduct of mining other metals like copper and zinc, meaning miners cannot simply ramp up silver output in response to higher prices the way they might with a primary commodity. At the same time, physical investment demand has been projected to rise sharply, and Comex registered inventories, the silver immediately available for delivery against futures contracts, have been thin relative to the paper obligations trading against them. This is not a rumor. It is a structural feature of the physical market that has been documented by multiple independent research desks. This brings us to the part of the story that has moved from fringe blogs into mainstream financial commentary, the gold revaluation debate. In 2025, the Federal Reserve itself published a research note examining how countries have historically revalued their gold reserves and what happens to a central bank's balance sheet when they do. This is a real published piece of research, not a rumor circulating on social media. The mechanics are straightforward. If the Treasury were to mark its gold holdings from that 50-year-old price of $42.22 up to something closer to the market price, the value of the asset side of the government's balance sheet would increase by hundreds of billions, potentially over $1 trillion, depending on the price used. That gain could, in theory, be used to offset debt issuance or strengthen the Treasury's general account without a single new dollar being printed in the conventional sense. It has happened before. In 1934, in the depths of the Depression, the United States raised the official gold price from $20.67 to $35 an ounce, a move that simultaneously devalued the dollar and improved the government's balance sheet position. In 1973, following the collapse of the Bretton Woods system, the statutory price was adjusted again to the $42 figure still used today. Both of these were real, documented events, not theories. The question being asked now quietly in policy circles is whether a third such adjustment is coming, given how badly that decades-old number has drifted from economic reality. I want to be very clear about something here because this is where a lot of commentary on this topic goes wrong. Nobody outside of the Treasury and the Federal Reserve actually knows whether a formal revaluation will happen or when. What we do know, because it is publicly documented, is that gold has been physically flowing from vaults in London into Comex warehouses in the United States at an unusual pace, with Comex gold stocks reportedly rising by more than 100% in a recent period, while London reserves fell to their lowest level in roughly 5 years. We know that questions about auditing Fort Knox, largely dormant for decades, have resurfaced in Washington. We know the Federal Reserve has published research specifically modeling reserve revaluations, and we know the fiscal math makes some kind of balance sheet relief increasingly attractive to policymakers. What we should not do is take those individual verified facts and stitch them into a confident claim that a takeover or a secret plan has already been executed, because that outruns the evidence. The honest position, the position any careful analyst should take, is that we are watching the pressure build, watching the pipes being laid, without yet knowing exactly when or how the water will be let through. This is a good moment to talk about why our brains handle this kind of uncertainty so poorly, because understanding your own psychology here is at least as valuable as understanding the balance sheet mechanics. When markets become uncertain, when headlines use words like collapse or crisis or takeover, your amygdala, the almond-shaped structure deep in the brain responsible for threat detection, activates before your prefrontal cortex, the part responsible for reasoned analysis, even has a chance to weigh in. This is not a character flaw. It is a survival mechanism inherited from an environment where reacting first and thinking later kept our ancestors alive. But that same wiring is spectacularly poorly suited to financial decision-making, where the correct response to fear is almost always to slow down, not speed up. Cortisol, the stress hormone released during this kind of activation, has been shown in behavioral finance research to increase risk aversion and impair the kind of patient probabilistic thinking that good investing requires. On the flip side, during rising markets, dopamine, the brain's reward chemical, creates a feedback loop that makes buying into a rally feel good in the moment, precisely when a disciplined investor should be asking harder questions, not fewer. Fear makes you sell at the bottom. Greed makes you buy at the top. Both are your own biology working exactly as designed, and both are usually wrong for your portfolio. Let me tell you about 3 investors, none of them real people, but each representing a pattern I have seen play out again and again. Because the numbers only mean something once you see how they land on real decisions. Consider someone I'll call Robert, 63 years old, 3 years from a planned retirement, who had spent 30 years building a portfolio that was almost entirely in cash and short-term bonds because he had lived through 2 market crashes and simply did not trust equities anymore. When gold and silver began their run higher, Robert watched from the sidelines for months, telling himself it was a bubble, until the fear of missing out finally overcame his caution, and he moved nearly 40% of his retirement savings into silver in a single week near a short-term peak, without any plan for what he would do if the price corrected. When silver pulled back more than 20% in the weeks that followed, driven by a shift in Federal Reserve rate expectations, Robert sold in a panic, locking in a loss he did not need to take on an asset whose long-term structural case, the supply deficit, the industrial demand growth, had not actually changed at all. His mistake was not choosing silver, it was choosing it emotionally with no framework at the exact moment. His own dopamine response told him it was safe. Now, consider someone I'll call Maria, 41 years old, a small business owner who took a completely different approach. Rather than making one large emotional decision, Maria decided 2 years earlier to allocate a fixed modest percentage of her savings, around 8%, into a combination of physical gold and a diversified basket of mining equities, and to add to that position on a quarterly schedule regardless of what the price was doing that particular month. She treated it the way a disciplined investor treats any insurance policy, as a structural hedge against currency debasement and fiscal dysfunction, not as a trade to be timed. When prices spiked, she did not chase. When prices corrected, she did not panic. 2 years in, her allocation had done exactly what she intended it to do. It dampened the volatility of her overall portfolio during a period when both bonds and cash were losing purchasing power to inflation without requiring her to correctly predict a single headline. And consider one more, a younger investor I'll call Daniel, 28 years old, who made the opposite mistake of Robert. Convinced by online commentary that a dramatic currency collapse was imminent, Daniel moved essentially his entire modest savings, money he would need within 18 months for a home down payment, into leveraged silver mining stocks, instruments far more volatile than the metal itself. When the broader market experienced a routine correction unrelated to the precious metals thesis, his leverage position fell more than his underlying conviction could have ever justified for money on that short a time horizon. His analysis of the macro picture may well have contained real insight. His position sizing and his mismatch between time horizon and instrument volatility were the actual failure, and it is a failure that has nothing to do with whether gold or silver ultimately go higher. Those 3 stories point at the same lesson from 3 different angles. Being right about the macroeconomic picture and being profitable as an investor are not the same skill, and confusing them is one of the most expensive mistakes in finance. Before we go further, if you're finding this useful, take a moment to like this video and subscribe, because we're about to connect the debt picture, the currency picture, and the geopolitical picture into a single framework. And the final piece of this puzzle is the part most coverage of this topic misses entirely. Stay to the end, because it changes how the first half of this video should be read. Let's talk about currency strength, because gold and silver do not move in a vacuum. They move in relationship to the dollar. And the dollar's story right now is genuinely complicated in a way that resists simple narratives. On one hand, the dollar remains the dominant global reserve currency, the unit in which most international trade and debt is denominated, and that status is not disappearing overnight. On the other hand, the share of global reserves held in dollars has been gradually declining for years as central banks diversify, and the twin pressures of a massive fiscal deficit alongside a Federal Reserve that must balance inflation control against the government's own borrowing costs create a genuine tension at the heart of monetary policy. When the Fed holds interest rates higher to fight inflation, it makes the dollar more attractive to hold and makes the government's own interest payments more expensive at the same time, a direct conflict between price stability and fiscal sustainability. When the Fed cuts rates to ease that fiscal burden, it risks reigniting the same inflation that erodes the dollar's purchasing power and historically tends to support gold and silver prices as real yields fall. This is not a partisan observation, it is simply the mechanical tension embedded in the current policy mix, and it is the same tension that has, in different forms, preceded major turning points in monetary history. Geopolitics adds another layer here that is worth taking seriously without overstating it. Central bank gold buying has accelerated in recent years, partly as a hedge against the kind of financial sanctions that followed geopolitical conflicts earlier this decade, when certain countries saw dollar-denominated reserves frozen or restricted. That experience taught reserve managers around the world a lesson they have not forgotten. An asset held physically within your own borders cannot be frozen by a foreign government's decision. Gold offers that property in a way that a dollar deposit in a foreign bank simply does not. Ongoing tensions in the Middle East, trade friction around tariffs, and broader questions about the durability of the post-Bretton Woods dollar system all feed into the same underlying demand for an asset that sits outside any single nation's control. None of this guarantees a particular price outcome. It simply explains, with real historical logic, why the buying behavior of the world's most sophisticated financial institutions has shifted the way it has. Now, let's return to the historical parallels, because history does not repeat exactly, but it does rhyme in ways that are instructive. In 1971, President Nixon closed the gold window, ending the dollar's direct convertibility into gold, and effectively ending the Bretton Woods system that had governed global finance since the end of the Second World War. That decision was not planned as a dramatic single event that the public understood in real time. It was a policy response to an unsustainable balance sheet reality. Foreign governments demanding gold for dollars faster than the United States could supply it. Gold, which had been fixed at $35 an ounce, was free to find its own price for the first time in decades, and within a decade, it had risen more than 20-fold, alongside a period of severe inflation that eroded the purchasing power of anyone holding pure cash. The 1970s also taught a second lesson that is relevant today. It took a Federal Reserve Chairman, Paul Volcker, willing to raise interest rates to nearly 20% and induce a genuine recession to finally break the back of that inflation. That is the kind of medicine that is politically excruciating and fiscally expensive precisely when a government is already drowning in interest payments, which is part of why some analysts argue today's policymakers may prefer the quieter route of currency debasement over the painful route of Volcker-style discipline. There's a bond market mechanic worth understanding here too, because it's the piece that connects the abstract idea of a debt cycle to something you can actually watch in real time. When a government issues more debt than the market is naturally eager to absorb, yields have to rise to attract buyers, which is simply another way of saying the price of that debt falls, because bond prices and yields move inversely. Rising yields on newly issued debt then raise the interest cost on the enormous stock of existing debt as it rolls over, which widens the deficit further, which requires even more issuance, which puts more upward pressure on yields. This is what analysts mean when they describe a debt spiral, and it is not a metaphor. It is a mechanical feedback loop that shows up directly in Treasury auction results. When auctions are described as weak, meaning demand fell short of what dealers expected, that is the market's way of signaling discomfort with the pace of issuance relative to the pace of savings available to absorb it. The Federal Reserve then faces an uncomfortable choice of its own. It can allow yields to rise freely, which tightens financial conditions across the entire economy, or it can step in as a buyer, effectively expanding its own balance sheet to absorb debt market is reluctant to hold, a process historically associated with looser monetary conditions and, over time, currency depreciation. This is the liquidity question that professional macro investors watch more closely than almost anything else, because it is often a more reliable signal than any single economic data release. Liquidity in this context simply means how easily and cheaply money can move through the system. And when a central bank is forced to become the buyer of last resort for its own government's debt, that is historically one of the more reliable early signals that the debasement path has been chosen, whether or not it is ever announced as policy. 2008 offers a different but related lesson. Less about currency debasement, and more about how quickly confidence in a financial system can evaporate once the underlying leverage becomes visible. In the years leading up to that crisis, the risks embedded in mortgage-backed securities were largely invisible to the average investor, hidden inside instruments too complex for most people to evaluate until the moment they were not hidden anymore, and the unwind happened with astonishing speed. The lesson is not that a 2008-style crisis is imminent today, would be an unsupported prediction. The lesson is about the pattern. Financial systems can appear stable for a long time, while structural imbalances build quietly beneath the surface, and the transition from stable to unstable often happens faster than the transition from imbalance to stable ever did. That pattern is worth holding in mind, not as a prediction of doom, but as a reminder that complacency is usually most dangerous exactly when it feels most justified. So, where does that leave us? Let's bring the Feds together, because this is the point where all the pieces we've discussed, the debt, the Fed's policy bind, the central bank buying, the physical gold flows, the silver deficit, actually resolve into a single coherent picture rather than a collection of separate headlines. The United States, like most developed economies carrying historically large debt loads relative to the size of their economies, faces a structural choice that has nothing to do with which party holds power in Washington. It can pursue the genuinely painful path of fiscal discipline and higher for longer interest rates, the Volcker path, which controls inflation and preserves currency purchasing power, but risks recession and makes debt service even more expensive in the near term. or it can lean gradually and often without ever announcing it explicitly toward the path of monetary accommodation and quiet currency debasement, the path that eases the debt burden in real terms but erodes the value of every dollar held in cash, and historically has coincided with strength in gold and silver as investors seek assets that cannot be devalued by policy decision. The gold revaluation debate we discussed earlier is best understood not as a standalone conspiracy, but as one visible symptom of this larger structural choice. A balance sheet maneuver that becomes attractive precisely because the harder fiscal choices remain politically unpalatable. Central banks around the world are not buying gold because of a secret plan whispered between finance ministries. They are buying it because the arithmetic of debt deficits and currency diversification points toward the same conclusion that gold buyers have reached at nearly every comparable moment in monetary history. Paper promises are only as good as the discipline of the institutions issuing them, and when that discipline comes under visible strain, prudent capital begins to hedge. That is the final insight, and I want to state it plainly, because it deserves to be stated plainly, rather than dressed up as a secret. This is not a story about a hidden takeover of an exchange. It is a story about a government facing a debt and interest burden it cannot easily grow, tax, or cut its way out of, choosing as governments have chosen at multiple points across the last century, to let the currency absorb some of that pressure instead. And about the world's central banks reading that same arithmetic, quietly repositioning their reserves toward an asset that predates every currency in circulation today. None of that requires a hidden hand. It only requires you to read the balance sheet honestly. What should you actually do with this? Not as financial advice, because I am not your advisor, and every person's circumstances are different, but as a framework for thinking clearly. First, separate your time horizon from your macro thesis, the way Maria did and Daniel did not. Being right about the direction of the dollar over the next decade does not help you if you have positioned money you need next year in an instrument volatile enough to wipe out short term. Second, resist the urge to make one large emotional decision in either direction. The mistake Robert made twice, once by waiting too long out of fear and once by moving too fast out of greed. Structural hedges like gold and silver tend to reward patience and disciplined incremental positioning far more than they reward dramatic timing. Third, remember that owning a hedge against currency debasement is fundamentally different from betting on a crisis. You are not rooting for the system to fail. You are simply acknowledging honestly what history shows about what happens to purchasing power when debt burdens grow faster than economies can service them, and positioning a portion of your wealth accordingly, the same way you might carry insurance on a home you sincerely hope never burns down. The old certainties about how monetary systems behave are not collapsing in some singular dramatic moment you'll see announced on a news ticker. They are eroding gradually the way they always have, through interest payments that quietly compound, through central bank purchases that accumulate ounce by ounce over years, through a 50-year-old accounting entry that policymakers can no longer comfortably ignore. Most investors will not notice this shift while it is happening because it does not arrive as a single headline. It arrives as a pattern visible only to those patient enough to look at the data across years rather than days. You now have that pattern in front of you. What you do with it is entirely your own decision, and it should be made calmly on your own timeline, based on your own circumstances, not out of fear of missing something, and not out of panic about losing something. Stay informed. Question every confident prediction you hear, including anything you hear from me, and remember that the investors who preserve wealth across decades are rarely the ones who move the fastest. They are the ones who understood the system clearly enough to stay calm while everyone else reacted. Thank you for watching, and I'll see you in the next one.